In January of 2026, a household needed about $93,000 a year to qualify for the median priced existing single family home in America, the price sitting right in the middle of the market, with half of all homes selling for more and half for less, around $446,000. By June, the income needed to qualify for the median priced home had climbed to over $109,000. That is $15,000 of income gone in 6 months. Nobody got a pay cut. The house just got more expensive to own. So, how much house can you actually afford right now in 2026? Here are the 8 income levels we're testing today: 30,000, 40,000, 50,000, 60,000, 75,000, 100,000, 150,000, and $200,000 a year. If you're buying with a partner, this is your combined qualifying income, not just one paycheck. That opening figure, 93,000 climbing to 109,000, assumed 20% down and counted only principal and interest. Our own numbers today will be more conservative, 10% down, with every real cost of ownership included. We're calculating a real specific home price for every one of those 8 incomes using a widely used affordability guideline: 28% of your gross income going toward housing plus every other cost of actually owning the place. Here's what matters before we go any further. Knowing that percentage doesn't hand you a home price. 28% of your income is just a monthly dollar amount. You still have to back out property, taxes, insurance, and a maintenance reserve first, then run what's left through the mortgage math. And it doesn't tell you what's actually left for you personally either. Your own debt eats into that number too. Watch what one ordinary bill does to a number built on that same benchmark. Take a household earning $55,000 a year, not one of our 8 income levels, just an example, completely debt free. Under today's rates, that income can afford a home priced around $149,900. Add one ordinary bill, a $530 used car payment, the current national average according to Experian. That same income can now only support a home priced around $87,900. One car payment just cut the number by more than 40%. That's not a rare exception. That's the actual math, and we're going to apply it to every income on our list in different ways: a car payment, a student loan, a down payment size, and a zip code. The 3 filters. So before we get to your 8 numbers, we need to see exactly what causes swings like that. Every lender runs your application through 3 filters before deciding what to loan you. The first filter is what counts as your income. The second filter is what you already owe. The third filter is your credit, down payment, and rate. Combine the first 2 filters and you get something called your debt to income ratio. More on that in a second. Together, all 3 produce your pre-approval number. Let's walk through each filter, then bring back all 8 incomes fully calculated for your real answer. The first filter: a lender doesn't look at what you say you earn. They look at what they can verify and count. Here's why they're so strict about it. Before 2008, some lenders handed out mortgages to people who couldn't actually prove they could repay them, and that's a big part of why the housing market collapsed that year. Today, with Americans carrying $13.19 trillion in outstanding mortgage debt, according to the New York Fed, lenders generally require real proof of income: pay stubs, W-2 forms, tax returns, or bank statements, though exactly which ones are required depends on how your income is earned. And that scrutiny doesn't land the same way on everyone. A salaried applicant with steady pay stubs and years of tax returns behind them generally has an easier time getting that income counted in full. Someone running a business that only opened last year, or leaning on bonuses and commissions that swing month to month, typically needs 2 years of tax returns before a lender will count that income at full value. The second filter: what you already owe. Lenders add up your required monthly payments, car loans, student loans, credit cards, child support, and any other debt sitting on your credit report, and treat all of it as already spoken for before your housing payment gets a single dollar. Remember that $530 car payment from a minute ago? Watch what the exact same bill does at a lower income. At $55,000, it costs about 41% of the number. Take an income further down our list, and that identical bill costs more than half. Same bill, lower income, bigger hit, and it never even shows up as a housing expense on paper. It just quietly eats the room your housing budget needed. We'll run the full math on this income by income in a few minutes. So, how do lenders combine what you earn and what you owe into one number they can actually act on? They use something called your debt to income ratio, your total required monthly payments divided by your gross monthly income. Two things go into that total. One side is your full housing payment, principal, interest, taxes, insurance, mortgage insurance, and HOA dues, all combined into one number. The other side is every other debt you already owe. The third filter, credit, down payment, and rate. The first two filters decide whether you qualify and how much of your income is even available. This one decides what the money actually costs you. A lender checks your credit history to price the risk of lending to you, checks how much cash you're putting down to size the loan itself, and lands on an interest rate that reflects both. Here's the chain. Your credit score helps decide your rate helps decide your payment, and your payment helps decide the price. We're using 6.5% today, the national average in the summer of 2026. Put those three filters together, and a lender hands you a mortgage pre-approval, an estimated loan amount, a price range to shop inside of, and a rate available right now. That number feels official. It feels like the answer to the title of this video. It isn't. A pre-approval tells you how much a lender may give you. It does not tell you how much house you can actually afford. Here's why that gap exists. The lender is asking one question: is this person likely to repay the loan? You need to ask a different one. Can I repay this loan while still saving, investing, covering emergencies, and living the rest of my life? The lender's math doesn't know about your childcare costs. It doesn't know you're helping a parent every month. It doesn't know about a medical bill, a retirement goal, a business you're trying to build, or a kid you haven't had yet. It only knows what shows up on paper. This is not about how much house you can borrow. It is about how much house you can actually keep. Call this the approval illusion, the gap between what a lender will hand you and what your life can actually absorb. Two households can hold the exact same pre-approval letter and have completely different amounts of room to breathe underneath it. The lender's maximum is never automatically your housing budget. And one more thing before we move to your real number. Every figure in this video is a national estimate. Location changes it more than almost anything else does. We'll show you exactly how much later. Let's come back to that idea. The lender's maximum isn't your budget. So where do you actually start if not the lender's ceiling? Here's the concept itself before we do anything else with it. The 28% rule says your total housing payment, principal, interest, taxes, insurance, mortgage insurance, and HOA dues combined, shouldn't run more than 28% of your gross monthly income. It isn't a number we picked. It's a real, widely used starting point for figuring out what you can actually carry. 28% is a starting benchmark for our calculations today. One more thing before your real number, and it matters more than it sounds like it should. A fixed rate mortgage only fixes your principal and interest. It does not fix your property taxes. It does not fix your insurance. It does not fix your HOA dues. So even with a perfectly locked in rate, your total monthly payment can still climb every single year. That's part of why every number you're about to see also sets aside a maintenance reserve, 1.5% of the home's value a year, landing between the classic 1% guideline and the 3% some recent studies point to once cleaning and full upkeep are included. This isn't money you're guaranteed to spend every year. It's money set aside for the year the roof fails, the water heater goes, or the HVAC system gives out in the middle of July. And none of those wait for a year when you happen to have cash sitting around. Every figure from here on also assumes a 30-year fixed loan, 10% down, 6.5% interest, the national average in the summer of 2026, 0.9% property tax, and 0.6% insurance. These are national estimates, not a personal mortgage offer. Okay, let's actually answer the question you came here for. Not the mortgage system, not the benchmarks, your number. Here's what $30,000, $75,000, $200,000, and every income on this list can actually afford in 2026 once every one of those pieces is accounted for. Here's the ladder. $30,000 a year is $2,500 a month before taxes. 28% of that is $700. That's the housing budget we're working with in 2026. Here's exactly where that $700 goes. $465 a month to principal and interest, $61 to property tax at 0.9% of the home's value a year, $41 to insurance at 0.6%, $31 to mortgage insurance since we're assuming 10% down, and $102 into the maintenance reserve at 1.5% of the home's value a year, money set aside for the year something breaks. Add it all up and it lands right back at $700 a month or $8,400 a year. At 6.5% interest on a 30-year fixed loan with 10% down, that $700 monthly payment supports a home priced around $81,700. That leaves $1,800 a month before tax for everything else in this household's life. At this income, there's essentially no room left for debt. Add just $200 a month in other bills, a modest personal loan or a smaller car payment than most people carry, and the price this household can afford drops to $58,400. That's a swing of more than $23,000 from $200 a month. That's not a personal failure showing up on your screen. It's simply what $30,000 a year affords in 2026, once every real cost of ownership is on the table. Step up to $40,000 a year and watch how quickly the picture changes. That's $3,333 a month before taxes. 28% is $933, the housing budget. $620 a month goes to principal and interest. $82 goes to property tax. $54 goes to insurance. $41 goes to mortgage insurance with 10% down. And $136 goes into the maintenance reserve. Altogether, $933 a month or $11,200 a year. At 6.5% on a 30-year fixed loan with 10% down that buys a home priced around $108,988, that leaves $2,400 a month before tax for everything else in this household's life. There's still almost no room for debt here. Add one ordinary bill, a $530 used car payment, the current national average according to Experian, and the price this household can afford collapses to $47,000 at $403 a month or $4,840 a year. One car payment just erased 57% of this household's buying power. Same income, same effort, a completely different housing market because of one bill. At $50,000 a year, the math shifts in a real way. That's $4,167 a month before taxes. 28% is $1,167. The housing budget. $775 a month goes to principal and interest. $102 goes to property tax. $68 goes to insurance. $51 goes to mortgage insurance. $170 goes to the maintenance reserve. Altogether, $1,167 a month or $14,000 a year. The price that produces is around $136,200. That leaves $3,000 a month before tax for everything else in this household's life. This is the first income level where real cushion starts to show up. Add the same $530 car payment and the price drops to $74,300 at $637 a month or $7,640 a year. That's a 45% cut. Serious but survivable, unlike the two brackets below it. Here's the other side of this income. Stretched to a looser 32% instead. with no debt at all, and the math allows $155,700 at $1,333 a month, almost $20,000 more in price. But that stretch only leaves this household 68% of their income, or $2,833 a month instead of 72%. Your stretch, not the bank's. A real lender's ratio skips our maintenance line. $60,000 a year tells a similar story with one new variable added in. That's $5,000 a month before taxes. 28% is $1,400, the housing budget. At our standard 10% down, $930 a month goes to principal and interest, $123 goes to property tax, $82 goes to insurance, $61 goes to mortgage insurance, $204 goes to the maintenance reserve. Altogether, $1,400 a month, or $16,800 a year, which buys a home priced around $163,482. That leaves $3,600 a month before tax for everything else in this household's life. Add the same $530 car payment, and the price drops to $101,600 at $870 a month, or $10,440 a year. That's a 38% cut. Now hold the income and the monthly payment steady and change one thing, the down payment. At 5% down, this income supports a home priced around $157,300 with mortgage insurance included. At 20% down, it jumps to $185,300, and that insurance disappears completely. Remember, PMI was never protecting you. It protects the lender, so losing it is real money back in your pocket. Same $1,400 a month either way. The down payment alone is worth almost $30,000 more house for the identical monthly payment. $75,000 a year is where multiple pressures start stacking at once. That's $6,250 a month before taxes. 28% is $1,750, the housing budget. $1,162 a month goes to principal and interest. $153 goes to property tax. $102 goes to insurance. $77 goes to mortgage insurance. $255 goes to the maintenance reserve. Altogether, $1,750 a month, or $21,000 a year, which lands this household at a home priced around $204,400. That leaves $4,500 a month before tax for everything else in this household's life. Add one car payment, $530 a month, and the price drops to $142,500 at $1,220 a month, or $14,640 a year. Add a typical student loan on top, $430 a month, and it falls again to $92,251 at just $790 a month, or $9,480 a year. Meanwhile, stretch to a looser 31% instead, with no debt at all, and the math allows $226,248 at $1,938 a month. But that stretch only leaves this household 69% of their income instead of 72. That's the whole video in one income level. $100,000 a year crosses into six figures, and the story changes again. That's $8,333 a month before taxes. 28% is $2,333, the housing budget. $1,550 a month goes to principal and interest. $204 goes to property tax. $136 goes to insurance. $102 goes to mortgage insurance. $341 goes to the maintenance reserve. Altogether, $2,333 a month, or $28,000 a year, which lands this household at a home priced around $272,500. That leaves $6,000 a month before tax for everything else in this household's life. That price itself can move before you even change zip codes, since property tax bills alone run under 1% of a home's value in some states and well over 2% in others on the identical house. Add the same $530 car payment, and the price drops to $210,600 at $1,803 a month. That's a 23% cut, the smallest of any bracket we've tested this bill against, because a bigger income has more room to absorb the same fixed costs. Here's where location takes over completely. In Metro Cleveland, where the median home is around $262,000, that budget buys the typical home in the entire metro area. In Tampa, Florida, where the median is closer to $400,000, it falls short of a typical single-family home. Across the greater Bay Area region, where the median is around $1,350,000, it doesn't come close. Not to a house, barely to a down payment. Three completely different home ownership experiences from the exact same paycheck. $150,000 a year pushes the ladder higher still. That's $12,500 a month before taxes. 28% is $3,500, the housing budget. $2,325 a month goes to principal and interest. $307 goes to property tax. $204 goes to insurance. $153 goes to mortgage insurance. $511 goes to the maintenance reserve. Altogether, $3,500 a month or $42,000 a year, putting this household at a home priced around $408,700 to $8,700. That leaves $9,000 a month before tax for everything else in this household's life. And that number assumes no HOA dues at all. A condo with a steep monthly fee can end up costing more every month than a pricier house with none, so this number can shrink fast depending on what you're actually buying. Now, layer in a real household, 2 car payments at $530 each, a student loan payment of $430, and a childcare bill of $1,230 a month. That's $2,720 committed before housing even starts. $150,000 a year is not a small income. Income alone was never the whole story. And at the very top of our list, $200,000 a year. That's $16,667 a month before taxes. 28% is $4,667, the housing budget. $3,100 a month goes to principal and interest. $409 goes to property tax. $272 goes to insurance. $204 goes to mortgage insurance. $681 goes to the maintenance reserve. Altogether, $4,667 a month or $56,000 a year, supporting a home price around $544,900. That leaves $12,000 a month before tax for everything else in this household's life. Even here, add the same $530 car payment and the price drops to $483,000. That's an 11% cut, smaller than any other bracket, but still real money. Worth noticing, actually, that same $530 bill has removed almost exactly $61,900 of buying power at every single income we've tested it against tonight, from $30,000 all the way up to $200,000. What changes isn't the dollar impact. It's how much room each income has to absorb it, stretched to a looser 36% instead, well above our 28% benchmark, and the math allows closer to $700,600 at $6,000 a month. But that stretch only leaves this household 64% of their income instead of 72%, $10,667 a month instead of $12,000. That gap over $150,000 in price isn't free money. It's pressure. Less cushion if the tax bill jumps, less room if the HVAC fails in August, less flexibility if one income in the household changes. None of this means $75,000, $150,000, or any of these numbers is a bad income. It means the mortgage industry's math and your actual life are two different calculations, and only one of them has to work for you every single month. That same market gap runs the whole ladder, by the way. At $50,000, your number buys real ground in Metro Cleveland and buys much less certainty in Tampa. At $200,000, even your best number still falls short of the Bay Area's median. Your income can work on paper while your zip code has nothing available anywhere near it. So here's the practical rule after all 8 incomes in all 3 markets. Don't buy at the maximum simply because a lender approved it, or because an agent tells you the payment is manageable, or because friends earning a similar income bought something bigger, or because a calculator online spat out a bigger number, or because you're afraid prices keep climbing and you don't want to miss the window. I'm not saying you can never enjoy your money or that every upgrade is a mistake. The issue isn't the house, it's what the house payment quietly removes. Your housing payment needs to leave real room for retirement contributions, for an emergency fund, for repairs, for health care, for food, for family, and yes, for some enjoyment of your own life. The right home price was never the largest mortgage connected to your salary. It's the home your income can carry while the rest of your financial life keeps functioning normally. Stretched to the absolute maximum, the bank approved, and the first property tax reassessment, the first insurance renewal, or the first slow month at work leaves no cushion left anywhere. Buy comfortably below your ceiling instead, and that same unexpected bill is an inconvenience, not a crisis. One last check before you sign anything. Stress test your own number. Could you absorb a real jump in your property tax bill? Could you handle a serious insurance increase? Could you replace an HVAC system without going into debt over it? Could you cover an urgent roof repair? Could you manage a temporary drop in income? Could you keep contributing to retirement the whole time? Could you handle a future childcare or medical cost you haven't budgeted for yet? Here's the final version of that test. If 2 of those costs landed at the same time, would you still be standing financially? If the honest answer is no, the number is too high, no matter what the pre-approval letter says. This isn't about assuming disaster is coming. It's about making sure one is survivable if it does. A number that only works when absolutely nothing goes wrong was never actually affordable. It was just untested. If your income doesn't clear your local market's number, I want to say this plainly before we go any further. That is not proof that you failed to work hard enough, save hard enough, or grow up properly. In a meaningful number of American zip codes, home prices have genuinely disconnected from local incomes. That's a structural problem in the housing market, not a personal one. Renting while protecting your financial stability is not failure. And relocating isn't always simple for someone whose job, family, and entire support system live in one place, no matter what the comment section says about just moving somewhere cheaper. It's easy to internalize a high price tag as evidence that you didn't try hard enough. That instinct is understandable, and it's also wrong. Supply, demand, interest rates, and decades of local policy decisions set prices, not your work ethic, which brings up the obvious sounding fix because it isn't actually a fix at all. Looser lending would let more people qualify. It would not make a single home cheaper. It would not lower anyone's required monthly payment. It would just place more people under more debt using the same lesson from before 2008 that we already learned the hard way. Giving someone a bigger loan doesn't make housing more affordable. It just moves the pressure from the front door to every month after. Approval was never the same thing as affordability. So what would actually move the number? Not easier loans, more supply. Research points toward a few real levers: building more entry-level homes, cutting back the restrictive zoning that blocks smaller, denser housing, and providing targeted help with closing costs and property taxes for first-time buyers, instead of simply handing them a bigger loan. None of these are simple fixes, and none of them happen overnight, but they attack the actual problem instead of just moving the debt around. Some cities have already started experimenting with faster permitting for smaller starter homes. Some states are revisiting single-family only zoning that's blocked duplexes and townhomes for generations. Neither one is a silver bullet, and neither one will show up in next year's price index. But they're aimed at supply, which is the actual lever, instead of just making it easier to borrow more against a price that stays exactly where it is. So, whether your household earns $30,000 or $200,000, the process never changes. Start with the monthly payment your income can safely support. Add the full cost of actually owning the home, then convert that number into a purchase price. Know what the bank may be willing to lend you, but buy the house your life can actually afford. Thank you for watching. Kindly subscribe.